Well, hello, I'm David Andolfatto. I'm with the Federal Reserve Bank of St. Louis, and we're here at the 39th Annual Fall Conference. And I have the great pleasure here of interviewing one of the participants, Iourii Manovskii of the University of Pennsylvania. Iourii is presenting a paper with the title Demand Stimulus and Inflation and Empirical Evidence. So you're looking at some empirical evidence behind this relationship between demand stimulus and inflation. Can you tell us a little bit, Iourii, about the question, the exact question you're addressing?
Sure. If you don't mind, I'll step back a little bit.
Sure,
I'll start
please.
A little bit further back,
Sure.
which would be helpful. If you look at what happened in the US economy in 2014 until now, what surprised a lot of people was unexpectedly strong recovery of labor markets. Unemployment declined substantially, employment increased substantially, so there is a roughly proportional flow of people from unemployment into employment. Vacancies are at all-time high, vacancies are very high. So what happened? What caused this unexpectedly strong recovery? One thing that comes to mind is that in January, or starting in January 2014, massive extensions of unemployment benefits that started during the Great Recession came to an end. And it could be that somehow the expiration of unemployment benefits caused this recovery in the labor market. So how would the story work? It's very simple. When you provide benefits to people, so people tend to, in equilibrium, demand higher wages. So wages go up. If productivity of workers stays the same, but firms have to pay higher wages to those workers, they have to hire fewer workers because their profits decline and job creation goes down. It's not to say that people are lazy. It's not to say that people don't want to work. Everybody wants to work. It's just in equilibrium, firms know that after they hire the workers, they will have to pay higher wages relative to workers' productivity, and that causes an increase in unemployment. So this was the story of the paper that I wrote a year ago with Marcus Hagedorn, Kurt Mietman, and Fatih Karahan, where we very carefully measured the effects of unemployment benefit extensions on employment, unemployment, and found very sizable effects.
Negative effects.
Negative effects on employment, unemployment benefit extensions increase unemployment, so they decrease, cause a decline in job vacancies. So these are negative effects, I think it's fair.
Well, let's be careful. Negative in those measures, but exactly. they could have, the insurance aspects could have had positive.
Exactly, and so one of the aspects in which our research was criticized was as follows, and the argument was made by Council of Economic Advisors, by Congressional Budget Office, who said, look, unemployment benefit extensions is one of the best stimulative policies out there. You provide money to people who would spend that money, will stimulate aggregate demand, will stimulate the economy, and could have substantial positive effects on the economy. Sure. And so the real motivation for this paper is trying to evaluate, is it really happening? Is the effect of unemployment benefit extensions on demand stimulus really as big as a lot of models that policymakers are using suggest it is?
Okay.
And if you want, maybe I can give you.
Well, let's step back a bit. I mean, you said, is it as big? Is the demand stimulus effect of, say, extending unemployment insurance benefits as large as these models suggest? But what does the evidence suggest, first of all?
So it's very hard to measure the effect of stimulus. It's very hard to know directly whether stimulus had a big effect or a small effect. And the reason is, suppose there is a state that has a lot of unemployment, you increase stimulus there, and you see that the economy recovers a little bit. It's not clear it recovers a little bit due to stimulus, and stimulus effect is not too big, or maybe the conditions in that state or that location were bad and maybe even becoming worse. So it's kind of always very difficult to tease out how big this effect is. And this is not what I'm going to be doing in this paper. So in the paper, I'm not really going to measure the effect of stimulus.
Okay.
What I really want to measure is the models that generate big, or that imply big effects of stimulus that policymakers are actively using. Are those models consistent with what we observe in the data or not?
All right. So the models that policymakers have in their minds, the models that justify in their minds the positive effects of these types of stimulus programs, you're interested in taking their models
Exactly.
and interpreting the evidence, some evidence that you're going to talk about,
Yes.
to see to what extent their models are consistent with this idea
Exactly right.
that a stimulus is actually, this type of stimulus in particular is effective.
It's an
This
excellent
is the
description
idea?
of what we do.
Okay. So tell us exactly then, what do you do and which model do you have in mind of evaluating?
So let me explain a little bit how standard models of policymakers usually think about
Okay.
it. So the reasoning is usually based on models in which prices are sticky. So there is some friction that prevents firms from adjusting prices. Okay? And now suppose you provide money to people. So people go and spend this money. So people go and buy stuff, it increases demand on firms. So firms, given that they cannot adjust prices, they sell more.
So more sure.
Okay? And so then in expectation, what happens? People know that eventually firms will adjust prices, so prices will go up. Okay? And now this is particular to the case of where a lot of people argued our economy was in the last few years. It's the case of the zero lower bound on interest rates, or the notion of liquidity trap. So the idea here is just the nominal interest rate is fixed at some low level.
It's as low as it can go, and
It's-
it's fixed for the foreseeable future.
And so then it has to imply that if you expect prices to go up, it means that you want to buy today. You don't want to delay your purchases in the future, you want to buy today. So in more formal economics terms, it means that real interest rate has to decline today. And it induces people to go out and buy stuff today. Okay? And that reinforces the effect of original stimulus. People go out, they spend more, and it amplifies the effect, and you can generate big stimulative effects from these policies.
The point is in the context of these models that you're interested in evaluating, the statement is when the nominal interest rate is at its lower bound, which it is today, that this type of stimulative program, you write checks for people, they're going to spend more, firms are going to increase their production, and people are going to foresee that prices are going to rise in the future.
And they want to spend even more
So
today.
this induces them to spend now before the prices rise.
And
So-
why it would not happen in the lower, outside of zero lower
So-
bound, it could be that monetary policies by central banks can undo some of these
I
effects otherwise. And here it's really a case where
the monetary
central
policy
bank
is
constrained.
fixed. And so this is this type of stimulus program will generate an inflation.
Exactly.
That's what the
Exactly.
standard model predicts.
Exactly. And so
How do you
now
evaluate this?
that's exactly where this paper comes in.
Okay.
So what we want to see whether unemployment benefit extension, so spending on benefits, really changes inflation relative to expected inflation in the way that would be consistent with these models and in the way that would be consistent with big, sizable stimulative effects
Okay.
of these policies. And to tease this out, what we do, we look at the United States, we look at counties in the United States, and we identify counties which belong to different states but border each other, so they're very close to each other. Now, unemployment benefit extensions are set at the state level. So state level, when economic conditions trigger unemployment benefit extensions, they are extended at state level and apply to all counties within the state.
Okay.
So this is the key part, that it's not the economic conditions of a particular county that determine unemployment benefits in the state. It's the total effect of the state. Okay? And then by looking at two counties that border each other that belong to different states, we can isolate the effects by observing what happens to prices, inflation, and in those locations we can identify the effect of stimulus spending on inflation.
I see. So the idea is consider two counties that border each other that are in different states.
Yes.
Consider one state that, say, enacts an unemployment insurance extension program.
Yes.
And then you want to study the behavior of these two counties that border each other
Exactly.
to see if they react differently
Exactly.
or not.
Exactly.
And suppose they react differently or not, what do you discover then?
And so what we discover is we look at, there is something that's called New-Keynesian-Phillips curve. This is a particular mathematical relationship that applies to this class of models that policymakers are using, which has a very intuitive interpretation. It says that inflation today is proportional to how costly for firms is to produce the last unit of output they are producing, plus expected inflation tomorrow.
So inflation is a function of the cost of production, what firms believe to be the cost of production, not only today, but also
going forward, because
also
remember, prices are sticky. If prices are sticky, it means firms may not be able to adjust prices.
So they have to make a forecast of how their costs are going to evolve in the
Exactly.
future. Okay, and so how does this relate into extension of unemployment insurance program?
Extensions of unemployment insurance programs means that you provide a transfer. So recall, it's very important that these extensions are financed at the federal level. They're
Okay.
federally financed extensions. So when unemployment benefits go in a particular county, it's a pure transfer of resources into that county.
Okay.
So when the resources enter the county, what you would expect prices to go up.
Okay.
And you would expect marginal costs of firm to go up,
Right.
because now firms have to hire more workers, they have to ramp up production, costs of doing so go up.
What you're saying is that the unemployment insurance benefits, the extension in the one county should stimulate more inflation vis-a-vis the neighboring country that did
Yes.
not. That's it.
Yes.
That's the implication of the theory.
Yes.
Now
With
you have a
maybe
bunch
with one caveat.
Oh,
So it's very important how you measure inflation.
Okay.
It's not just pure inflation. It's inflation today minus expected inflation tomorrow.
Okay.
Because it's this object that is related to the cost of producing for firms in the model.
okay.
And it's exactly this object that we can essentially, looking at the data through the lens of the model, is this change in prices that informs us about the changes in costs.
What
for
sort of
firms.
data do you have that it permits you to identify this object? What sort of data?
So we use Nielsen retail scanner data. So it's a data set which has approximately 40,000 retail stores, and we
Okay.
see the sales of those stores of all the goods they sell at a weekly frequency. We see volumes they sell, we see price at which
Okay,
they
so
sell.
you've got this huge data set of
Yes.
all these retail prices of all sorts of goods and
Yes.
services, I guess?
No
goods.
services. So these are
Okay.
grocery stores, these are pharmacies, and these are mass merchandise stores.
So you can actually track in great detail how these prices are going to change
Yes.
over. Okay, good.
Yes.
All right.
And when we look at those prices, they do not evolve in the way that the standard model would predict.
I see.
In particular, the evolution of prices suggests, if you interpret that evolution of prices through the lens of the standard model,
Yeah.
suggests that costs that firms are facing are not affected by fiscal stimulus.
All right.
Which basically means that fiscal stimulus or transfers of resources to a county do not drive up the cost to firms. They do not drive up expected inflation, and so they cannot have any stimulative effects.
Well, it had no effect on inflation, but these unemployment insurance checks, did they stimulate spending?
Yes.
They did. Okay, so without driving up costs, marginal costs.
Again, it's a little bit of a tricky question. They do not drive marginal costs or costs to firm, only if you measure those costs the way the models that policymakers are using tell you those costs have to be measured.
I see.
You can measure it in a much simpler way. You can simply ask, do prices, you can do several things. For example, you can ask a simple thing, do firms increase spending? Do total sales at firms increase when consumers in a county receive transfers? And the answer is yes.
Okay.
Okay, so those transfers do increase
Consumer
sales,
spending.
do
Okay.
increase consumer spending. It's also true that if you just look at prices, you don't measure these prices in a way consistent with those models where you take the difference between the prices and expected prices tomorrow. If you just look at prices, you see a fairly strong response of prices. So prices do go up in counties that receive
Oh, okay.
transfers. So in this sense, there are stimulative effects of these policies.
Right.
The only question is, if you try to interpret those effects through the lens of models, you do not see, you would say that those effects are not there.
So that's a very subtle point you're trying to make. What you're suggesting is that these types of programs may be stimulative,
Yes.
but not for the reasons that policymakers typically think. Would that be a fair way of?
That's a fair interpretation. So essentially the argument is it's either, if you really believe in the class of models that policymakers are using, those policies are not stimulative, or they're stimulative, but not for the reasons underlying those models. Okay? And it's natural to expect, even if you take a pure frictionless model with no frictions on prices, for example. So in those models, transferring resources to a particular county would stimulate spending, at least to some extent. So you would expect some effect along the lines of what we find.
Mm-hmm.
What you do not find is this big amplification of the effect through the sticky prices mechanism underlying those policies.
I see. And this is important because it would, well, the policymakers that are relying on these types of models to organize their thinking on other matters, I mean, they may be flawed, I suppose is what you're saying.
Yes.
Are there competing models that might do better?
There are. And
do you talk at all about them? Or?
We do some. So in particular, we look at one class of models which also feature pricing frictions, the STT information type models. So the idea there is once in a while, grocery store, let's say, managers make a forecast of how they expect the economy to evolve. They program their computers, they program a pricing plan, and so there are prices that evolve over time according to those pre-specified plans, and people infrequently update those plans in light of the new information that they collect. Okay. It's too costly to do it very often, so people only update those plans occasionally. So we cannot dismiss or we cannot reject that class of models as
without getting, we don't have to get into the details of what these two models are, but okay, so there's a competing model that potentially does better. There's kind of the conventional one that doesn't do so well. What sort of mistakes might policymakers make by relying on this model vis-a-vis the one that you just described that does a bit better? Would they imply different types of approaches to stimulus, or?
It's the question is how big are the effects of stimulus.
So
the other model would predict much smaller effects of stimulus than the original model. So the wisdom of stimulative policies could be
called into question.
Into question.
Oh, okay. Well, very good. I thought at one point you said, I'm going to wrap up here, but how much data do you have? Like how many data points do you have in your paper, in the data set?
So in the data set on prices, we have 79 or 76 billion observations.
76 billion observations. Okay, very good. Well,
it's a massive amount.
Incredible. If you had to sum up in just a couple of sentences, kind of the takeaway, like the main points of your work, what you've accomplished, or maybe even going further ahead in research, what needs to be accomplished, what would you say? How would you sum it up?
I would say a few things. So one conclusion I draw that a lot of well-intentioned policies would have very negative impacts, which are going counter the original design. For example, the policy of unemployment benefit extensions, either it's motivated by its potential stimulative effects or by the desire to help unemployed people, actually hurt unemployed people. Mm-hmm. And hurt them not because, again, it's crucial to understand, it's not because people are lazy, it's not because they don't want to get a job, they all want to get a job. Unemployed people are desperate to work. It's just the fact that when they get employed, wages will have to be higher if their well-being is improved when they are not working, and it pushes an upward pressure on wages. Firms know that wages are going to be higher. Firms are not creating jobs for those people. And those people do not get a chance of having a job. Mm-hmm. So the well-intentioned policy which tries to help unemployed people can actually hurt unemployed people and hurt them substantially. And so one takeaway is we have to be really, really careful about thinking and understanding effects of these policies.
Very good. Thank you, Iourii.
Thank you.